Good afternoon. Peter Klein, Align Wealth, Chief Investment Officer and co-founder, with you this afternoon on the 26th of August for our August briefing on the conditions as we see them. Thanks for participating, and we will share the screen and go through a few comments, some graphs and charts in the hope that it will frame how Align Wealth is seeing the current conditions and how we collectively work to benefit our clients, to keep them on track through the winding road of the financial markets. So allow me to share the screen and we will get started. So here we go, number 2. And as you probably see, we've got a kind of an interesting title to today's talk. It's a thought that came to me about a movie. You all know The Good, the Bad, the Ugly with Clint Eastwood, and it's part of the spaghetti western series of years ago. So I hope this, helps you understand, or helps, at least it helps us frame how we're seeing the current conditions that are out there. So let us proceed with the good, the bad, and the ugly. So the good, from our view, earnings thus far pretty good. Probably clocking in at probably close to 7% year-over-year growth, and obviously a good deal of that is in the tech sector, and we're seeing that, and so that's on the good side. I would frame the political situation as a more muscular administration, and we don't know where that might go, but for now, it's certainly active, and I think that's perhaps a positive going forward. Certainly better than being non-active, I would think. And the peace dividend, and potentially, if that's in the cards, that's a positive. That's a good, right? If that were to come to fruition. On the bad side, we're going to talk about the fact that we have debt and deficits, and that is troubling to your friendly chief investment officer here. How can it not be? Right? I mean, we're talking about $39 trillion of national debt. That's not going down, but going up. We're talking about deficits in the 6%, maybe 7% range going forward, and interest rates that are not going down substantially in our view. Yes, we might see a tick down or so on the short-term curve from the Fed, but I don't see a case for substantial decreases in interest rates. And let's hope we don't get that circumstance, because that would suggest a recessionary or nasty economy. I don't see it. I see labor, as last month especially was a little choppy, but we get that with labor statistics. But for the most part, I think it's fairly, let's call it flattish. And maybe there's some cracks that are coming. We're always looking at those tea leaves to see. But for the most part, I don't see much there. I definitely do worry about the deficits and the cost of those deficits going forward. Valuations, of course, as you know, we are a valuation shop here to some degree. We believe that price matters, and that while everything might be exciting and everyone's dancing on the tables, we are always the ones that are pulling the punch bowl away and sort of saying, "Hey guys, it's time to calm down." That's just what we do. Remember, we are wealth managers. We're not hedge fund managers. We're not rolling the dice for our clients. Our job is to keep our clients in good position and compound wealth over time. You do that by being a steady Eddie. You do that by missing the downturns. Those are the most pernicious and the most hurtful to a long-term compounding record. So avoiding those is important to us. And market concentration is another reason to be somewhat on the bad category. As you know, as we've spoken about many times before, 10 stocks in the S&P 500 are now more than about 40% of the S&P market cap. That's wildly, wildly concentrated. And if history has shown us, when we're this concentrated, it's time to wave the yellow flag. All right, so those are the bads, at least 3 of them. Now for the ugly: speculative froth, meme stocks, crypto, AI, IPOs. I mean, come on, guys. We've been doing this for a long time. We've seen many a market cycle. We understand how this goes. It's getting a little heated. And I don't mean just because it's August. It's getting a little heated. And to that end, I'm first to say I'm a little concerned. Valuation is not a short-term trading metric or tool. However, we are not operating in the short term. We're operating over time. Compounding takes time. So, as compounders, we need time, and over time, over the longer term, 5, 10 years, valuations are extremely important. And so, at these levels, it's suggestive that the next 5 or 10 years are not going to be as straight up as maybe one would have thought. We'll see. Rationalizing AI's CapEx spending? Are companies benefiting? That's a big question on the ugly side because there's a lot going on in AI, a lot of spending, hundreds of billions of dollars. What are we getting for it? And again, I want to make sure we understand that sometimes this happens, that things get exciting and there's a new technology. Let's go back 25 years. We could sort of similar narrative. And then things get overdone. And when things get, this is the nature of investment. This is the nature of capitalism, right? When things get overdone, prices get, you know, values get insanely high. And this is when we have issues. So we're concerned about that. Let's hope that AI is the long-term game changer. And if that would be the case, it would be wonderful. And there are lots of great things that could come from it, and we'll be part of that, no doubt. But we have our concerns, given that we're not seeing dramatic impact yet from the AI spending that's been done. Next and last is the labor market softness, a canary in the coal mine. We talked about that. We're confident that it's not. We're confident that we're not going into a deep recession or even a recession. We do believe, however, that it will be slow. There will be a slow economy, and therefore, with stubborn inflation, we're in something called we'll call it a light stagflationary environment. That's what we're sort of thinking that we're going into, and as you know, with if an economy is not overheating, but rather softening, and yet you have pesky inflation or stubborn inflation, and we could go through the 3 Ds, of why that's the case. But be that as it may, that puts the Fed in a bit of a pickle as to what they do with interest rates. On one hand, they want to lower them to spark maybe the economy. On the other hand, they have inflation concerns that are percolating and they can't decrease the interest rate. And this is very much like where I think we might be in this box, this sort of difficult paradigm. And if that plays out, that's ugly. So that's where sort of the big message here with the good, the bad, the ugly. Let's go through a couple of slides to frame this discussion in greater detail. On the good side, we have AI's promise, right? And I want to make a point here that's important. I'm an advocate of AI. I mean, I've loved what it's done in our family and it's done for lots of great businesses, to some extent, technology, of course, and healthcare. And that's a great thing. And it's been around for, in that case, it's been around for a couple of years with sensors and such like that. I want you to think about the concept of picks and axes. It goes back to the days of the gold rush in California in the, I guess, early 1800s. And the guys who made the money then were not the speculators who were going out with their little pan in the river searching for gold, but rather the sort of Levi Strauss folks and the folks selling dungarees and picks and axes to those folks. And that's where the money was made. When we think about new technology, think about the second or third, iteration or opportunity from that big theme. And so cybersecurity, copper, because you need data centers, HVAC, because you need data centers. These are energy, right? These are the things that come to mind when we're thinking about the AI revolution. Here's spending in AI and data center spending explicitly. And here again, you see how much has been spent. And you ask yourself, well, wait a minute. If they're spending this much on data centers, how are they protecting those data centers? What companies are playing into fire protection? What companies are playing into HVAC to cool the data center and security? These are the things that come to mind, and these are potentially opportunities. But you got to do the work to find them. And here again, data center annual energy consumption. That's an issue. You can't have a good data center, an operating data center without good energy sources. So we're looking at that, where these data centers are going to be positioned geographically, what sources of energy are there, and how can we take advantage of them from an economic investment perspective. Emerging market stocks have gone nowhere, and I think there's an opportunity here with emerging markets. So I put that in a sort of good category. There's an opportunity. It's not going to be straight up. There's going to be some volatility, but the stocks are cheap. And that's and these countries and companies, many of them have done very well, but they're just not getting the premium valuations that they had once gotten and have not gotten for many years. And maybe it's time there's a turn happening there. Value is extremely cheap, and therein lies another sort of good or maybe even great opportunity to look at. Definitely look at value as an opportunity. We're certainly doing that. And you also have a built-in margin of safety there, a cushion. When you're buying a deep value stock or you're buying a company or fund that's investing in deep value, you're getting explicitly a margin of safety because you're buying low. You're buying a low valuation at low valuations. So if things go a little awry, at least you have a buffer, and you could not get, whipsawed as much as you would potentially in a high multiple investment. And here's that margin of safety right here. And this is showing that there really isn't a margin of safety, at least not in the S&P 500 price to book ratio. And that's important because as investors, as wealth managers, as people who are entrusted and fiduciary centric investment managers focusing on our clients' dreams and aspirations and retirement, etc., and legacies, we're here not to sort of swing for the fences with other people's money, but to keep them on base, keep scoring, keep compounding, and compounding over compounding works. We're trying to avoid the downdrafts. That's what we're trying to avoid because those can be painful to the compounding over the long term. Quantitative analysis gives us these circumstances where we can look at how investments are currently valued. And as you can see here on the S&P 500, with a current estimate of $266 a share, you could see where your PE multiple is. Should we have a PE multiple in the mid 20s? I don't know if that makes a lot of sense given the current economic conditions, nor do I think it makes a lot of sense um, at all because things just get overheated at those levels and they're bound to come back down. So as you can see from this chart, we're in sort of rarefied air here. And to that end, we believe that things are getting a little dicey and concerning, and it gives us pause with new money coming in as our clients provide us with new opportunities to assist them and their families and folks that they care about come to us from referrals. We're here to say to them, we're going to allocate your capital carefully, perhaps even slowly, as we use volatility to our favor and buy low. But we're also going to allocate that capital opportunistically. It's not like we're sitting on our hands and waiting. We're looking at opportunities that have that margin of safety or that thematic approach, as I mentioned earlier with the Pixes and the Axes, to give us a forward growth without essentially the high risks that might be associated with other companies. Price matters, always has, always will. I mean, yeah, sure, you could buy the greatest company in the world, many folks do, and you're going to pay up for that. And the question is, will that multiple always be there? Because, the company can still do great, as we've seen over time, many times again, the darlings of the 1960s and the 1950s, 60s, even in the 70s with the Nifty 50 and the dot-com stocks in the turn of the century. And the companies still do well, but their multiples never catch up to where it was. That's the key. The key is to find both a company that has good growth, consistent growth and cash flow generation, good, strong earnings quality, but with a multiple that increases. You're getting a double win. You're getting a growth in the actual operations of the company, but then you're getting people paying more for that growth. Well, you're not going to get that if the multiple is in the stratosphere. That multiple only can come down. It can't go up. So what you want to do is find those companies that have both an expanding multiple and expanding operational success. Now, when we look at inflation, and we're somewhat in the camp of sticky, definitively in the camp of sticky inflation for many reasons. We've spoken about that many times before in these videos. But when you see something like this, when tariffs increased dramatically from what they were, um, that has to have implications. And the implications, sure, there's more money coming into the government, and let's hope that they put that to good use, like paying down the debt. And I don't know how much that is comparative to what they expect or what could be expected, but I know one thing: someone's paying for that increasing cost of that good, and it's likely to be, at least in part, the consumer. And so when you see that, it's hard to argue that it's not inflationary. Now, the question is, how inflationary is it, right? So we're not suggesting it, we're not giving you that number. We don't know it. We're giving you is stubborn inflation. It's not coming down. It's going to stay around. And when it stays around, it gets pernicious. It gets built into the economy. And that's not great for equity investors. So we need to be careful at that. And then this is an interesting chart that shows the decreasing net income growth for what is affectionately known as the Mag 7, as well as the S&P 500, and then the S&P again, 93, those that are not the 7. What I want to point out here is the red bar, which is the Mag 7's net income. And what you can see here, the net income growth, okay? From my lens, that looks like a declining growth rate. Um, that's not what, that's hard to support. Let me say it this way. It's hard to support the robust, putting it lightly, robust multiples that the Mag 7 are getting on their earnings, when their earnings are when the growth rate of those earnings are decreasing, and in some cases looks like it's decreasing substantially. That has to be, we have to do, stories are great. Stories sell. I get it. At the end of the day, we got to suffer the numbers. We got to do the work. We got to see what's behind these stories to make sure they're valid, because we're fiduciaries to our clients. And we're always going to do that. We're always going to take the extra step to do the work, not just listen to a story. And so that's what we're doing here. And this is showing you that, hey, maybe there's something here. Maybe we need to be more careful where we're putting our capital. And this is the ugly. No ifs, ands, or buts about it. This looks at the S&P, different parts of the S&P market, or different parts of the U.S. equity market, rather, and since Liberation Day. And look at what has done the best. Not the NASDAQ up 38%, although that's heroic, or the S&P at 27 since April 9th. Look at what happened to unprofitable tech, up 57%, or maybe ARC, or maybe Quantum. Look at what's happened to these different meme stocks. Hey, folks, this is speculative froth. So I leave you with that as a concern. And, it's important that we're always here for you, and that we appreciate your vote of confidence. Let me stop to share. And wishing you the very best at this end of summer. Enjoy Labor Day weekend. Enjoy the rest of the summer. We'll be back to you in September with updates on our conditions and where we're seeing opportunities. Have a great summer.